Now, we're going to move on to restricted stock. What you see here is a chart from Stout Reeses Ross off their website. And this is the stuff that really kind of might have some validity, but not in the way you think. At the top, you have studies that were done way back in the 60s and 70s and 80s. In 1990, there was a change in the rules, 144 rules, which allowed more freely the restricted stock to be more freely traded. And what happened is that it became somewhat more liquid, and so institutional buyers could get in there and they could buy this stuff. And what that did is it kind of squeezed the discounts down from about 35–40% down into maybe 20–25%. All right. But it was still a 2-year hold. 1997, they went from 2 years to 1 year. And then in 2008, went from 1 year to 6 months. A lot of people will look at this chart and forget the fact that you have a completely different holding period. So what people do is they say, some people who have a reason to get a higher value will say, oh, the discounts for lack of marketability have gotten smaller over time. Well, you know, there's a reason for that. And the reason is that the holding period has gotten shorter and shorter. So the shorter the holding period, pretty soon you get to a public stock value, right? You get a 0 holding period and you get a 0 discount. Now remember, those numbers on that chart were original issue discount stock. What those do is the company goes out, and basically it's a way to slide in a secondary offering, otherwise known as a private investment in public equity pipes. Slide that out there and sell some stock to get some more capital without having to actually file for a secondary offering on the public markets. And so that's the original issue discount study material. We also have actual transactions between third parties in restricted stock. And Espen Roback was one of the people at Plurus Valuation who studied these transactions between actual third-party investors having nothing to do with capitalization of the company, but these transactions would occur on restricted stock trading network and second market and those kinds of platforms. So he went and looked at the transactions between independent third parties and found that the same kind of pattern happens here, but it's actually bigger discounts for shorter holding periods between independent third parties. And probably part of that has to do with the fact that the company's not really getting anything out of that. One of the things he did was he put together some confidence intervals from that data. And this is not data. This is confidence intervals to show that as time goes along, the discount gets bigger. And what's remarkable to me is that you get the confidence intervals, cover discounts of 50%, average 50% over not very long time, about a year or so. From that, what you can do is use that incomplete data and extrapolate to the kinds of holding periods that my clients have. And I don't know about you, but I've had clients where they inherited the stock, they couldn't sell it, and they died with the stock. And it's just, I mean, there's some cases that you hear of where people go their entire lives and hold this stock, not necessarily because they want to, but because they have to. This also incorporates something that Espen talked about in his work, which is that the discount, as you extrapolate it, it's really a quadratic extrapolation because you can never get a discount that's more than 100%. So even if you go out 100 years, the discount can't be 100, it could be 100%, but it's not going to be more than 100%. So, you know, I looked at all this stuff, and I have been puzzling over this for many years. But the light bulb went on in 1998 at this conference in Maui when Dennis Dolan, who was the restricted stock trader at Nomura Securities, got up and started to talk about how the investors invested in restricted stock. Now, this was right at the moment in time when the holding period went from 2 years to 1 year. And so I think that was probably why he was asked to speak at the conference. And what he said was, you know, the buyers in these cases look at the time frame that they're going to be holding the stock. They look at the potential appreciation or not in the stock. They look at, in other words, what is that future residual value going to be? They look at their required holding period and the required rate of return. And so it's really a probability-weighted discounted cash flow analysis. And I don't think a lot of people really picked up on that, but I did. And I went and talked with the block desk at Lehman, and I have talked, and this was before things got bad with them, but when they were still a firm, but it was, you know, this is the kind of stuff that people use to get to these discounts. Behind every discount is an income approach. Underneath every discount is an income approach. What he said was, you know, our people use between 25 and 30% required rate of return, and we have a 1-year hold, and we expect there's going to be some kind of appreciation in the stock. So if there is a 5% appreciation in the stock over a 1-year period, your discount's going to be somewhere in the 20 to 25% range. Because you're going out at 5% growth, and you're coming back at a 25 to 30% required rate of return, so the discount's naturally going to be somewhere in the 20 to 25% range. You take those concepts and you put them into the kinds of holding periods that my clients have, and probably your clients, and you think to yourself, all right, so how long is my client going to be stuck in this stock? If I purchase this stock, how long will it be before I can get out of this thing at a pro rata value? And, you know, what's that future residual value going to look like? And what is my required rate of return? I mean, this is a minority interest in a private company. What kind of risks are there? And how do I get that required rate of return? Well, so we'll get into the required rate of return in a minute. But you just take the math of it, and let's assume a 5% growth rate, you know, holding periods, you know, from 0 to 30 years, required rates of return from 10% to 30%. It doesn't take you too long to get to a discount of 70 or 80%. I mean, most of my stuff, you know, you're in there for a minimum of 10 years. And if you have any kind of risk involved in this private company, you're probably at a 20 to 25% required rate of return. 10 years at a 25% rate of return is an 82% discount. It's just math. This is not an opinion. It's only math. And here's a graph of what the math looks like. It kind of looks similar, doesn't it? Underneath every discount is an income approach. So the question then becomes, well, how big of a discount is too big? I mean, you get this all the time from people who want to have a high value. I could never believe that somebody would sell at a discount of 80%. It just, you know, nobody would do that. Well, guess what? If you go back to the restricted stock studies and you look at not just the averages or the medians, but you look at the high end of the discounts, you get discounts easily in the 70 to 90% range. And these are people who actually purchased restricted stock that will eventually become liquid, and they may or may not have been distressed. The sellers may or may not have been distressed sellers. We don't know. No one's ever done any research to try to find out what exactly happened in those circumstances. The question is, why? Why are these things happening? So the idea that no one would ever sell at such a big discount is completely unsupported by the evidence. Let me show you how you get a discount of 100%. I've talked with people in the private equity space, and talked with a firm that does secondary market private equity. They go out, they buy up used private equity. And there was a time when there weren't very many firms doing this. There are now quite a few more firms that are out there trying to get into this private equity market in a secondary way. What this shows is that the seller in this case put $1 million, $500,000, $500,000, $500,000, $400,000, $300,000, and $200,000. So they've, you get these capital calls. You keep pumping money into the thing. Well, what they do, what the private equity firm does, is they then take the money and they go invest it, and then they return it to the limited partners. Now, let's take a look at the cumulative investment line, right above the year-end pro rata NAV. So that gives you the actual net cash flow to the company, and so in the fifth year there, they've made money. It is actually that $625,000 represents a 21.6% total return on their investment, and it represents an 8.4% IRR on their investment. Now, it happens that the general partner, in this case, values the remaining portfolio at $300,000. The other thing, too, that's going to happen here is that there's another $200,000 that is going to be a capital call for another 2 or 3 years. The seller, in this case, does not want to have to put out more money. They're going to pivot from this investment into some other type of investment. They've got a strategic focus. They get rid of this thing and get into something else.
On the buyer's side, the main issue is what the portfolio is worth today, because it's assumed that future capital calls will be worth what the fund pays for them. The buyers I've spoken with go through each portfolio company individually, and they forecast future exit possibilities for each company. They then discount those exits back to the present at a risk-adjusted rate of return, which is usually at least 25 or 30%. In this example, after looking at each portfolio company, the buyer believes that the general partner is overvaluing the portfolio. Possibly the general partner is getting the $300,000 from some appraisal firm that's using control premiums to help him get values up to cost basis so he can avoid a write-off. The buyer realizes that the numbers are inflated and discounts the portfolio value from $300,000 down to zero.
In the meantime, so they put this out on the market and they try to sell it. In the meantime, there's not very many buyers. And so the private equity firm that I was talking to, they could purchase this for $1. And they could do that because there were not enough buyers out there to create a market. The seller was very happy to sell and get out of it so they could move into something else. They had already made their return. They're willing to sell at a discount, and a discount of 100%. And this goes on all the time. Not just, it's not common, but it does go on all the time. You have real people, investors, selling firms like this and selling at 100% discount. Now, like I said, the market has changed, and sometimes these things sell at premiums because the pension fund really likes this firm, and they really want to be in this venture capital or this private equity firm. And so they have so they will purchase it at a premium because there's a lot of competition for these deals now. Everybody's looking for some yield. So I give restricted stocks a yellow light because I think there is some validity and some way to re-envision how restricted stocks are analyzed if they're looked at from the standpoint of why do we have these discounts, not just what are the discounts. So this method does not work, at least, except for partly perhaps for the restricted stock studies. But for the most part, all of the factors here can be proven not to be valid, and nobody who puts their money into these deals actually uses that method.